Welcome to TheoTrade. This is Don Kaufman. February 10th, 2021. A glimpse of sell-side activity hitting today's markets. You know what? If you just tuned into the marketplace here, let's say it's the end of the trading session, and you look at the S&P futures and you're like, well, what's he talking about? You know, the S&P futures, where are they at the end of the day? They are massively unchanged. I mean, for the most part, the only thing that you see some sell-side activity maybe was the Russell. But I'll tell you what, we really did. We got a pretty good glimpse of some ugly movement inside of the marketplace today. Yes, the marketplace happened to recover, but it's glimpses of risk like this that as traders and investors, you got to prepare. If the marketplace can throw off this magnitude of volatility in such a short period of time, this was some sell-side activity today. You just didn't know if it was going to stop. And I actually want to display this a little bit because, again, you know, you look at this stuff at after hours and, you know, the chart and you're like, oh, whatever happened here, it doesn't really matter. It just bounced back up. All of this basically occurred inside of a 30-minute period, and when we started the sell-side activity, the S&Ps were roughly trading at, 39.20. They actually bottomed out here right around, we'll call it 38.80 people. That is, about 40 handles lower. But then to quantify the amount of time it took for that to occur, and you're looking at a period of about, 30 minutes, and that's exactly what I said over here. 30 minutes and 40 spoo handles later, that is some fairly tumultuous volatility. Taking a look at the Nasdaq actually took the brunt of the hit. And again, it bounced back, neither here nor there. That's a 250-point reversal. 250-point reversal inside of the Nasdaq, inside of, again, 30 minutes. And this is sell-side activity that we did not necessarily know if we were coming back from. And the Russell, on a percentage basis, pretty much took the largest hit of the bunch. The Russell was actually trading 23.13 before trading, 22.62 again on a percentage basis, getting smacked. All of this again inside of a 30-minute period. At the exact same time that was going on, volatility absolutely exploded. And this is just a quick glimpse of the VIX. The VIX, I don't necessarily think tells the entire story. These are the volatility futures, which were kind of at the 23 at 40 level and actually spiked all the way to 25.15 before reverting back down. And, you know, this is where everybody's looking for comments. And is this, it's that, it's Jerome Powell. You know, before that, we actually had CPI numbers. Listen. Some sell-side activity. It doesn't matter what generated it. It matters, okay, that you are prepared for that kind of volatility moving forward. Because one of the things that's missed, you know, when I say that, you know, you got a glimpse of some selling in the marketplace, you're getting a glimpse of what the marketplace is capable of. And again, some of the percentage moves that we saw are a little bit alarming, specifically in terms of volatility. You know, I didn't even get to the half of it here. When it comes to volatility, I like to look at stuff like the VVIX. And the VVIX, it took off out of the gate this morning. You know, this was actually a little bit of a tell. Yesterday, the VVIX, yesterday closed right around the 108 handle, and this morning actually opened at 112. And before some of the sell-side activity hit the marketplace, the VVIX was already flying, but finished the day, roughly speaking, at about 115. Again, the VVIX finishing about 6% higher, again, which is still indicative of some, maybe possibly continuation of risk coming into the marketplace. The other thing that is abnormally high is unequivocally some of the skew. If you never looked at skew before, skew is actually running close to the 140 handle. That's the out-of-the-money puts versus the out-of-the-money calls. And again, skew is extraordinarily heavy. But getting down to business. So you see this glimpse of sell-side activity hitting the marketplace. You know, what does it mean? Again, it means for the most part, get hedged, which I'm going to talk about here momentarily. But there's a few other signs and some things that have changed today before we actually talk about, you know, the hedge and really changing anything up. First and foremost, the bonds. The bonds had a complete and total reverse, okay, inside of trade. And most of this was actually sparked from a very flat CPI number. This is it's inflation. Okay, so it's basically, you know, goods and so forth. But what you're looking at right now is inside of the bond market. And in the bond market, Okay, this is prior to obviously the cash open. This is an hour prior to the cash open, but the CPI number came out, and the bonds completely reversed course and continued to do so throughout the course of the trading session. You know, one of the things that was a real standout today, and again, even though the S&Ps finished kind of flat and we saw a little bit of volatility, some of the standouts today, the bonds complete and total about face. Now, with the bonds starting to rock once again to the upside, you would expect that the financials would have felt a degree of pain. And even though they reversed early on with the rest of the marketplace, they finished massively unchanged in today's trading session. For the most part, the S&Ps finished unchanged. Okay, the financials unchanged. The monsters of tech were unchanged. I mean, through and through. For the most part, the marketplace is unchanged. But one of the things I want to key into on this is if the bonds continue to uptick, even here in the after hours coming into tomorrow's trading session, those bonds did monumental volume, monumental size. And I'll tell you what, this is going to start to impede upon the financials. If you start to impede upon the financials, and what we're talking about is bonds rallying. If the bonds are going to rally, it's going to take the associated interest rate where? Lower. Interest rates are coming down a little bit. If interest rates are going to come down because they're going to say, there's no inflation whatsoever. Don't worry about inflation. We don't need higher interest rates because there's no inflation. They're going to start to actually whack the financials. If you whack the financials, you'll take down the S&Ps. That is a key component right now. As I said, bonds, they reverse trend. Okay, but the XLF for now is holding up. We'll see if that actually continues. All right. As I said, volatility kind of flew. Now, one other aspect that I think is incredibly important to understand here, and this is for the remainder of week, and this is talking about your overall risk in the marketplace. You know, on this trading week, and I take expected move, right, very, very seriously, especially like on a Wednesday. And why so seriously? You know, what's the difference between a Wednesday and a Monday? You know, you're here early in the week and you're looking at the expected move. The expected move this week is plus or minus, okay, about $63. So you're looking for the $63 move higher or $63 move lower. So here we are early in the week. And early in the week, you're like, whatever, $63 move higher, $63 move lower. Well, here we are right now, and we're, beyond halfway through the week, right? You got Thursday, you got Friday, and right now we're right there. Okay, and when I say right there, and I just want to be able to quantify this for you for a second, right in this neighborhood here. In fact, we'll even zoom in for a second. So you start to get a feel, okay, not only for expected move, but this is about the capabilities for the remainder of the trading week. Okay, so let me actually, as I said, I wanted to quantify this. Right here is where the marketplace currently is. All right, so right there. And where does that actually leave us? Well, the upside edge of the expected move, okay, is all the way through 39.50. All right, so where do we have? About 40 points of movement to the upside. To the downside, you're actually looking at about 38.23. Again, that's the upper and lower edge of the expected move. In any given week, you should expect that we're actually going to tag up here or tag down there. And why I take it so seriously when you're on a Wednesday afternoon, and I always talk about this on the Wednesday evening video, if we haven't tagged the upper or lower edge of the expected move, again, there's an incredibly high probability of doing so. So at this point, you got to expect, you're going to go up at least 40 points or, okay, we're going to come down hard and fast. And hard and fast, I mean, you're looking at a move from 39.09 all the way down to, 38, 20-ish. That would be a monstrous reversal inside of the marketplace. So, again, it is to be considered, especially considering we just saw, again, a glimpse of volatility, which is, kind of the theme tonight. And again, I can't get over this because I don't think people... again, you look at the marketplace at the end of the day, there's a few things that are tells in here. Number one, the volume in the S&P futures, we did 1.5 million contracts. You're like, who cares, man? 1.5 million contracts. So what? Okay. You know that the volume in the previous day, just crested over about 800,000 contracts. All of a sudden, the volume, it didn't clear double, but it got pretty close to it. A day that we're absolutely unchanged and the volume doubles. on a trading session is a little bit of a tell. Okay, the fact that the bonds reversed course over here is a little bit of a tell. The VVIX got ramped up is a little bit of a tell, and that's why I'm telling you, like, listen, the SPX is right smack, in that kind of middle of the range. You should expect some serious volatility on Thursday and Friday. So don't look for the quiet, lonesome kind of week here to the end of the week. At this point in time, right, I really strongly urge you to use option spreads anywhere and everywhere you possibly can. There is a tremendous amount of risk in this marketplace. I'm not here to tell you whether to get bullish or bearish. I think everybody has to make up their mind over here. There's no easy argument for like valuations, especially, when people are trying to make arguments for like stuff like Tesla. Look, Tesla, it was down today, but they're trying to make arguments for like Tesla and the valuation of products like this. And I can't help but to point out, companies like Uber. All right, and the reason I'm actually pointing out Uber, all right, here's one that actually had earnings in the after hour. Lyft was the day before, but the point that I want to make about Uber, and we talk about like valuations and so forth, let's just spend a second on this, okay? What I'm actually pulling up right here, right now, is a 3-year, which, Uber hasn't even been around necessarily that, but I wanted to pull up pretty much the full chart in terms of Uber. And one of the things that I wanted to point out is that Uber, here is the onset of the pandemic right here, and Uber is where it's trading in the 60 range. Okay, the company's done nothing but take an enormous hit. Okay, and yet they are a tremendous amount higher than they were at the onset of the pandemic. And you can look at this, and there's absolutely unequivocally there's no fundamental basis behind it. So at this point, you got to realize as an investor, okay, there's no investment here. This is nothing more than a momentum position to the upside. And with that, I urge you, you don't go out there and just buy calls. And you don't buy calls in something that's got this high of volatility. And the same thing is true of even something like Tesla. And people are like, I'm going to go out there and buy some calls. Use spreads. Mitigate risk. Okay? Mitigate volatility exposure. I don't care if you're bullish. I'm serious. I just don't care whether you're bullish, whether you're bearish in here. Doesn't matter to me. But I'm going to tell you right now, when I say use spreads, look at the implied volatility. It's begging you to use spreads in here. With implied volatility like this, even if we rally, they're probably going to crush down the volatility. So you use a vertical spread to mitigate some of that exposure, whether it's Apple, whether it's Amazon, whether it's Google, whether it's an Uber out there, okay? All of them use spreads when and where possible, mitigate that risk. Because right now, again, with a glimpse of sell-side activity, well, that's all we got today. We don't know if there's necessarily going to be follow-through, and there are many signs of volatility starting to emerge inside of this marketplace. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.